Nobody likes a tax man knocking at your door, but how much tax are they actually coming after you for? This is a question I get quite a lot on the channel because you've worked hard to generate your money. Okay, there's going to be tax, but what is the liability? And more importantly, how can you mitigate against that? Something I want to say black and white is I am not an accountant, nor am I financially qualified in any way to give advice. This is just one man boy's opinion. Just to give some context to this, if you're asking because it's genuinely of interest to you, then great, carry on watching this video. If you're watching as a decision-making tool to if you should get involved in property as an investment or not, get that out of your head straight away. What you need to understand is most taxes are paid on genuine profits. So you have to make a load of money before you need to worry about tax in the first place. You get taxed in any way, shape or form in the UK if you make a property in and out of property. So don't make it as a decision-making process, but focus on it to mitigate your expenses through tax. The UK loves tax, and I mean loves tax. If you work hard and earn some money, you get taxed. As soon as you want to purchase something, you get taxed. As soon as you want to spend money, you get taxed. And then you make it to the end of your life and you're like, oh, do you know what? Finally, I've been squeezed all the way. And then the inevitable happens and then you die. And then you're taxed when you die as well with inheritance tax. So there is such a huge amount of tax from start to finish. I once heard a stat mention that for every pound earned at the top ends up being around 19 pence at the end of it. It's like, that's crazy. But when you factor in corporation tax, national insurance on both sides, the employer and the employee, VAT, income tax, capital gains tax, purchasing tax, everything we do is taxed all the way down. And then of course the inheritance tax is just the final straw, right? So as a buy-to-let investor, it's a really shrewd move to focus on mitigating this ongoing expense moving forward. Buy-to-let tax actually starts before you've even gained a profit, which is absolutely insane. Remember when I said you got a purchase tax as well? Well, in property, that is known as stamp duty or SDLT, stamp duty, land tax. And you're actually taxed based on the value of the property. So anything below 40,000, so £39,999, there is zero tax to pay. Anything above that up to 125 is 3% tax, and then it starts scaling upwards with 5%, upwards and upwards and upwards. I would recommend checking out the stamp duty calculator online, which is by the government, so it is accurate. What is important to understand is, much like all taxes, it's banded, apart from corporation tax, which is fixed, but all income tax and tax on stamp duty is banded. So the higher the price, the higher the percentage increase. So for example, up to 1.5 million, you will pay 13% stamp duty, but that is not on the full 1.5 million, it's on the band. So it does increase incrementally as the bands go up, but you have to be aware of it. If you're buying a £100,000 property, for example, you're going to pay £3,000 in tax by purchasing that property. Now that you own it, there is going to be tax applied to any profits, but that tax changes based on how you bought the property and what costs you're factoring in. So a few years back, most people purchased a property in their personal name. And this made complete sense because you could offset a load of different costs, namely a mortgage and the interest rates within that. There was also quite a lot of tax relief, and so you could own a load of properties in your personal name, comfortably retire, and really mitigate and delay any tax that you pay on that, including refurbishment costs, the mortgage interest, etc. So I knew a lot of landlords that had worked their entire life to retire based off of their portfolio, and then something came in called Section 24. Section 24 is essentially the government coming in and saying, hey, I know you've built this portfolio, but we're not going to count the mortgage interest now as a legitimate business cost if you own your property in your personal name. What? So what happened overnight? People could be profiting after tax $40,000 a year, and I know people that very suddenly were making less than $20,000 a year from the exact same portfolio just because one day the government went, things are changing. From the government's point of view, what they wanted to encourage is more people purchasing in a limited company, if you like, and they did give 4 years for people to start shifting it over and getting effective tax planning, but it still had massive cost implications to it, but really means something for us as investors moving forward. To be really honest with you, this only really impacts those in a higher tax bracket, i.e. they're paying the 40% tax bracket. The reason for this is the first 20% is tax deductible, and so if you're paying 20% income tax, that's not really going to be impacted. So if you're in a situation where you're only going to get a handful of properties, you're not intending to make more than the currently $40,000 a year, but it obviously goes up and up and up, then maybe you want to buy it in your personal name. Most of us are investing in property, number one, because we're earning a bit more money than the basic taxpayer rate, but also you're looking to increase that income over time. Now, I can't advise you to invest from a limited company, but you may want to factor that in and get your accountant's advice on that. But this really starts to impact with Section 24 at the 40% tax bracket. So if you're not going to buy in a personal name, what will you buy in? The two most common are LLPs and LTDs. An LLP is a limited liability partnership. So first of all, you need 2 of you as a minimum on there, not just 1. So if it is just you, you can't do that anyway. If there's 2 or more of you, you can do that. Hence the word partnership. Now, the way that tax is structured in a limited liability partnership is as an individual, but you can write off a lot of expenses as the corporate entity. I'm going to be completely honest, I know the least about that in terms of corporate structures, so I'm not going to talk too much about LLPs. I recommend if you are in a partnership that you talk to a qualified accountant that will know what they're talking about. The other is a limited company. Now, when you own a property in a limited company, people find this really confusing. You don't own the property. That's not a bad thing, by the way, but you don't actually own it. The company owns the property, and then you own the company. That's really important from a corporate structure point of view because you don't own it, all of the asset and therefore the liability is within the company, unless you've signed a personal guarantee for the loans, which I'm not going to go into. But also the taxation of the property is in the corporate structure because the company is taxed, not you as an individual. Well, why is that important? Number one, because it is a business activity, obviously, you can deduce or deduct the tax in there, including the mortgage, which is obviously a huge part of it. But also you can deduct other things like the refurbishments. If you're going networking that's directly related to the business, all of these activities are tax deductible. My personal opinion is, as a business owner, I'm trying to live as much of my life through the company. Now, this will really depend on if you're a full-time landlord or a part-time landlord, and there's a lot you can get deducted. For example, networking, some flights, some work clothing, etc. But this has to be legitimate in terms of deducting expenses, and there's a big difference between avoiding tax, which is perfectly legal, by the way, and actively encouraged, to evading tax. And evading tax is completely illegal and you definitely don't want to go near it. So talk to your accountant about the difference. Avoid as much as you can, obviously. do not try to evade it. For most property investors that I know that are looking to scale a property portfolio, a majority of them are buying in a limited company. I can't advise you that's the way to go. Most of my properties are purchased in different limited companies for strategy, structure, and tax reasons. I'm not saying you should do that. You need to talk to an accountant about your personal situation. But for me, it does make sense because I am in that higher tax income earnings range, which means I'm going to get taxed differently to some of you watching this. But also, I'm impacted in a lot of different ways, which I'll go through in a moment. The reason I like it is the tax percentage is also different. So on the profit, I paid corporation tax rather than income tax. Corporation tax is a set 19% in the UK. So I pay 19% corporation tax on that. However, it is meant to be going up to, at the point of filming this, up to 25% by 2025. So it does get less appealing. However, despite the fact it's reduced and you are technically paying less tax in the company, there's going to be a couple of things that you need to be aware of that means it might actually be worth paying more tax if you want to utilize the funds. The first big thing to think of is your exit plan. We all have different exits. It might be you're using it for retirement. It might mean you're going to sell off the portfolio. For me, it sounds a bit morose, but my exit is death. I don't want to sell any of my long-term assets. Don't get me wrong, if somebody offered me a ridiculous price, then I could buy some more with that, then yes, maybe I would. But in general, my exit is death. It's all about legacy for me. I want my kids, my grandkids, and to help as many people around me with the portfolio. So with that in mind, it makes a lot more logical sense to have it in a business from an inheritance tax point of view as well, because I can think about trusts, but there's also massive reliefs about inheriting a company rather than the asset separately. Bear in mind, inheritance tax, thanks Bojo for this, is 40%. So after you've earned all of that money, paid all of your taxes through your life, everything above currently £325,000, which is tax-free that bit, is now going to be taxed at 40%. Imagine every 100 grand that you give your kids, 40 grand of it goes back to the government. What? Absolutely insane. However, in a company, it's structured slightly different and there's business relief in there where actually a lot of businesses you can completely eradicate it, but more importantly, you can plan more effectively. Always have the end in mind. The final thing to consider is, do you need access to the money? This might seem really obvious because a lot of people buy property to retire on, and that might make sense down the line. But if you don't need the money now, a limited company will probably, just my opinion, be the logical answer. Whereas if you want access now, it may be more logical in a personal name, despite the fact that you're going to pay more in income tax than corporation tax. And not many people talk about this, but the reason is dividend tax. I know, another bloody tax, right? So dividend tax changes over time, but in general, so the first £2,000 is completely tax-free. The next band isn't too bad. Dividend tax at 7.5% if you're a basic rate taxpayer, 20%. So it's not too shabby. But bear in mind, you've just paid 19% corporation tax and then the 7.5, which is going up to 25% corporation and then 7.5. So still makes sense compared to paying that on the income side over here, if it's in your personal name. But after that, if you reach the higher income tax, you are paying a whopping 32.5% dividend tax. So you've earned £100,000. Let's say by 2025 it's 25%. You've then paid £25,000 of that profit in corporation tax. And then you want to take that 75 grand out. Let's say you're a higher income tax earner. You're then going to pay 32.5% of that to the tax man as well. What the hell, Boris? Do us a favor, man. But the point is, you're going to get hurt either way. Tax is painful. And Do you know what? I'm not actually against tax. I quite like tax in the sense of if there's a fair taxation, ultimately you're paying back into a system that has allowed you to do all of this business in the first place and invest in infrastructure, and it helps a lot of people that need the help. My problem is, why would you pay more tax than you need to? I definitely think we should all be strategic about the mitigation strategies of tax. So those are the two options. It really does depend on where you're looking, and other options may be available that I'm not aware of. Please, as I said, take this with a pinch of salt. It is completely one person's opinion and is very subjective based on your situation. Talk to somebody that is qualified, that will definitely know more about tax than me, an accountant or a financial planner, for example. But let me know in the comments, where do you think you're going to end up? Put LLP, LTD, or personal in the comments now. And if you're new to the channel and you want to find out more about investing, make sure to subscribe and hit the notification bell to find out more about property investing. And if you did get value from this video, it would help me tremendously if you likely tap the like button whilst you watch this new video.